Most investors never look at the balance sheet, they track earnings. They watch revenue grow. Then they wonder why a profitable company suddenly collapses. The balance sheet is where the real risk lives, and in the next 7 minutes I'm going to show you exactly how to use it to find stocks the market is mispricing. Consider this. In 2022, several high-growth tech companies reported strong revenue and still went bankrupt within 18 months. The income statement looked fine. The balance sheet told a different story. Assets were shrinking. Debt was piling up. Cash was running out. Investors who read only earnings missed all of it. The balance sheet is a snapshot. 3 sections: assets, liabilities, equity. Understanding the relationship between those 3 sections is how you find stocks that are genuinely cheap versus stocks that just look cheap. Let's break it down step by step. Every balance sheet follows one equation. Assets equals liabilities plus equity. Always assets are what the company owns. Cash, inventory, equipment, intellectual property. Liabilities are what it owes. Debt, accounts payable, deferred revenue. Equity is the residual. What's left for shareholders if you paid off every creditor? So what does that actually mean for investors? It means equity is not a number you can trust blindly. It depends entirely on whether the assets are real and whether the liabilities are fully disclosed. We're going to check both. Price to book compares market capitalization to book value. The net assets on the balance sheet, a PB below 1.0, means you're paying less than the accounting value of the company's assets. Historically, that's been a strong signal of undervaluation, and especially when the assets are tangible. Example, in 2012, Apple traded at a PB of around 4. In 2016, it dipped closer to 2. The balance sheet was healthier than the market implied. Over the next 4 years, it tripled. This one tells you how much of the company's growth is funded by debt versus actual shareholder value. A DE above 2.0 isn't automatically bad, but context matters. Amazon runs high DE by design. It invests aggressively. A retailer with high DE and declining revenue is a different story entirely. Current assets divided by current liabilities. If this drops below 1.0, the company may not cover its short-term obligations. That's a liquidity warning. It doesn't mean collapse, but it means cash pressure. The data shows that companies with a current ratio below 0.8 see significantly higher distress rates within 24 months. 3 free sources. Each takes under 2 minutes to load. Source, where to find it, what to pull. Ixalma Sec Edgar, SecGov, Edgar, 10K annual filing, balance sheet, macrotrends.net, macrotrends.net, pre-built, PB, DE, current ratio charts, wise sheets, stockanalysis.io, free tier available downloadable balance sheet by quarter. Always use the most recent quarter, not just the annual filing. Balance sheets shift fast. Let's run the signal score on the balance sheet as a concept, rating it across all 5 factors. Factor score 10, evidence, order to business, quality 8, 10, balance sheet. Quality is the strongest single predictor of long-term solvency. Companies with net cash positions outperform leveraged peers by 1.4% annually. Pharma French data. Valuation 9, 10, PB below 1.5 plus, current ratio above 1.2. Historically, strong entry signals. Backtests show positive 3-year returns in 74% of screen cases. Momentum 5, 10. Balance sheet health alone doesn't predict short-term price movement. Catalyst needed. Earnings, buyback, or sector rotation. Risk 7, 10. Low DE and high current ratio are direct risk reducers. However, Off-balance sheet items, leases, SPVs, can obscure true exposure. Sentiment, 6 to Tier T, markets often ignore balance sheet strength until a liquidity event forces attention. Contrarian edge exists. Patient capital wins here. Total signal score 35-50 verdict. The balance sheet is the most underused tool in retail investing. It doesn't predict timing, but it separates genuinely cheap companies from value traps with reliable consistency. The single most common mistake, trusting goodwill. Goodwill is what a company paid above fair value during an acquisition. It sits on the asset side. But it's not real. If the acquisition underperforms, that goodwill gets written down. And when it does, book value collapses overnight. In 2019, General Electric wrote down $22 billion in goodwill. The stock fell 39% that year, so here's the adjustment. When you calculate PB, subtract intangibles and goodwill from equity. That gives you tangible book value. Tangible book value is what's actually there if things go wrong. The market rarely prices this correctly. That gap is where the opportunity lives. Here's the takeaway. A company's income statement tells you how it performed. The balance sheet tells you whether it can survive. Investors who read both make better decisions. Investors who read only one eventually pay for it. The next signal score drops this Friday, and I'm running the full framework on a mid-cap industrial with a PB under 1.2, zero net debt, and a current ratio of 1.8 subscribed so you don't miss it.